Hi guys, hope you're having a great week. Today we're going to talk about time frames. Everyone has been taught time frames in a different way. So some people have been taught that to enter at 1 hour to daily. Some people have been taught to only stay on the lower time frames, et cetera, et cetera. So I'm going to show you my way of doing it and what I think is the most profitable. So we're just going to look at a random chart. We're going to look at GJ. So I'm just going to clear the chart and we're going to go over this. So on the monthly, we are looking for the overall trend. So basically, we can see that since 2020, we've been completely bullish on GJ. Okay. So right now, actually, we are hitting a monthly structure. And so essentially, if this 195 price can break above, we will continue to the upside with GJ. If this 195 price cannot break above, it will continue down. So that kind of gives us a bias of what is coming next. So the monthly we use as a higher time frame trend. So we're figuring out, okay, what is the overall trend? Why we don't draw areas of reaction on the monthly time frame is because of the fact that the zone will be too big. So if you draw this from the candlestick body and above and we jump down on the 4 hour, this is way too big and you're not going to have any idea of where to enter, where to put your stop loss, stuff like that. So if we actually measure this would have been 150 pip zone. That is way too big. Your zone is going to be a max of 20 pips on currency and 30 pips on gold. So when we go down to the weekly, we're kind of getting the same bias, except one candle equals 1 week instead of 1 month. So it's just kind of dropping down a little bit. So instead of a 1 month candle, we're looking at 4 weeks. So it's the same thing. We're looking at the overall trend. We know it's bullish. Okay, so the daily is where we can spot more information in all the candles, obviously. So essentially from going from high to low, we're just breaking it down to get more and more and more price action. So on the daily, we can spot specific levels. So for example, we can spot daily reaction levels, which basically even this zone actually lines up with the monthly zone. So we have multiple confirmations that if this specific price, so 195, if that 195 and 194.9 cannot break above, it will continue further down. So basically, we can just mark up our daily areas of where price is going to reverse or potentially break. Another reason why I like the daily is you can see the direction and the trend of what we are going to trade on the 4 hour time frame. So for example, if we mark up some daily zones, which I know it ranged a little bit, so it's kind of messy. Like if we go down to the 4 hour, we can see that this took a while to actually break out. But if we go on the daily and we mark up our areas of reversal, so I'm just going to do this really quickly. Okay, we'll just start with this for now. So if we mark up our structure on the daily, this will give us a key of what the direction is. So for example, if we started at this low around 180, what is this, 187, we need to determine if this is going to be bullish from here or bearish. Okay, so if we look on the left, we can see that this was bearish. It ended up breaking and testing that price and then continuing up. This once was bearish. It ended up breaking and testing that price. This was bullish, and this was once bearish as well. Okay, so the idea of this in regards to direction is if these two prices at this zone cannot break below, it will be bullish. as this ended up breaking and testing, staying above those two prices. This ended up breaking and testing, staying above those two prices. So in this case, if structure comes down and it cannot break below that 187, then basically we know it's going to be bullish by just looking left. If, however, these two prices did break below and test in, the direction would be bearish based off this example and this example. Okay, so that's kind of how we get our direction. So same thing with the next zone above. So these two prices at this zone, for example, the 4 and the 170, okay? So for example, if this price, so this was bullish, so let's just say you took a buy on a lower time frame and you were thinking, okay, well, what's my target? A lot of people reach for way far away targets, like for example here, which is 560 pips, which it did get there. But the point is like you have to go level by level, section by section. So for example, we know, okay, this is bullish, this is bullish, this is bullish. So it was bullish more times than it was bearish. It was only bearish twice in this scenario. So obviously we can get the direction that, okay, it's going to be bullish. So these two prices though have to break above in order for it to be bullish. And then basically we can extend to the next target. Okay, so the same thing applies. So we get our prices at this daily zone. And so for example, that 580 and 729 has to break. Okay, so we see it bullish from here. We see it bullish from here, bullish from here, bullish from here, bearish, bullish, it manipulated and then closed, and then bearish. So we have 1, 2, 3, 4, 5 indications that it's going to continue bullish if those two prices break above. Okay, so obviously it did. It obviously broke and tested. Okay, so we can extend it to the next zone. It's repetitive every single time. So you just have to look left. That is the key. Okay, so that's what we do on the daily zone is we look for what that current trend is for the week, and then also what the direction is. Well, direction and trend is the same, but point being is you look for the direction and trend on the left-hand side. And we can look at that at the daily. You can draw daily zones. Like, so for example, if we drew a daily zone here and we jumped on the 4-hour, basically, you can just adjust it, which this doesn't need adjusting, actually. This is fine. Just make sure that the zone does not exceed 20 pips. That's like the rule. But to be honest with you, what I do is I draw them on the 4-hour anyway, because I feel like it gives enough. So drawing them on the 4-hour time frame is what I do for major zones. So I'll quickly draw them up quickly. So again, there's a lot we're working with here because of the fact that it ranged for a little bit. You don't have to draw like too many. When you're back testing, I mean, practice as much as you want. But when we're actually focusing on like the overall trend, the present trend of what's happening now, you don't need to have all these prices marked up down here. Just focus on where current price is at. So if current price is at around 194, you can mark up around 193, 192, 196. But you don't have to mark up all the way by 188. As price, like if price ends up dropping and we end up breaking all these levels, you can add them in as it's trending, because then that way, like it avoids your chart from being really messy. You want to keep it really clean and organized and be able to know what's going on. So we can have our major zones on the 4-hour, and then I jump down to the 1-hour and have the minor zones in between. And the reason I do this is because from the major zones, if we draw this to the next zone, this is about 170-ish pips, right? So that is a lot. And so that's a lot to work with in between. So if you sold, for example, so this was actually a daily level. So this was the first reaction it manipulated. This was the second or third. You always enter at a second or third reaction to avoid the manipulation. So for example, like if we sold at this price at 641, and yes, obviously our target can be here and here at the next major structures. But the point is when you're in a live trade like this and you don't know what's going to happen next, basically you want to make sure it does respect your prices, right? So there's a lot of reactions in here that we need to make sure that breaks. So we have a reaction here. We have a reaction here. Here, et cetera, right? So we want to make sure that these prices, so if we sold here, we want to make sure that all of this breaks. It obviously did, and it actually retested this bottom price. So that's our clearance. But the point is like to make you comfortable and make you confident, you have to add those next extra numbers in there while you're in that trade. Because if you just have the major zones, it can correct and you're going to freak out and think that it's going to come up to your entry. There's so many emotions going on. So you just want to be prepared ahead of time. So you can draw the minor areas with an actual horizontal ray, or you can draw a zone as well, whatever you feel comfortable doing. My group members are all different. Some, actually majority of them do like zones and prices on them, but some just like lines, and that's totally up to you. It's such a, like I said, it's such a personal preference. Okay. So that is it for the higher time frames. Now, when price gets to a major structure like this, basically all you're doing is breaking it down. So what you're doing is as price approaches on a higher time frame, you're then jumping down further. So all it's giving you, so pay attention to this major zone right here. Actually, here, let me highlight it for you guys so you can see. Okay, so if we go down to the 30-minute, we can see more price action. If we go down to the 15-minute, we see more price action. If we go down to the 10, the 5, et cetera, we're seeing more price action on the number, on the price that we want to enter on, okay? So that's the reasoning for entering on a lower time frame. Now, here's the trick. If you enter way too soon on the lower time frame, like if price is approaching the major structure and you jump down too soon, like here, let's just say you jumped out. So this was the manipulation. So let's just say this rejected and you entered here. And you didn't wait for it to manipulate, and you didn't wait for it to test into that major structure based off the higher time frames. Basically, you would enter, it would come down a little bit. You'd think that it's gonna, come down to this target, which it eventually will. But the point is you're getting in way too early because you're jumping down way too soon. So you have to get the higher time frame confirmation first, wait for it to hit the two prices at the major zone, and then jump down and get it. So obviously this is the first reaction overall, and then basically it will come down and it'll come up and correct because a new day is coming in and new sessions. So for example, if this is Tuesday at London, New York will bring it down, and then basically the next day will come in. Tokyo and London will bring it back up because they want to get in at a better price to add some sell orders in. And then the next session does that as well. They bring it down, they bring it back up to that same price, they add more sell orders, and then basically after that, it starts trending down. So, and really the most important thing is that structure is actually responding to the levels that you have in. That is the most important thing. So another question that I get is people will say, oh, well, you're scalping if you go on the lower time frame. That's what they tell me. And I'm like, no, I'm not. So here's the difference. You're going down on a lower time frame and you're getting the entry at major structure. Okay. There are sometimes, obviously, you're going to enter like at the second reaction and it might come up for a third reaction. It's fine. You can either take profit as you see it coming back up. You can take profit and re-enter at that same exact price, or you can just wait. It's totally up to you and how your mind works. Everyone's mind is capable of doing everything or different things. So it just depends on if you have the mental capacity to actually hold the trade. Sorry, I forgot my words for a second. Yeah, if you have the mental capacity to actually hold that trade and like have your emotions mastered and stuff like that, then I mean, you can hold it and just wait for it to, and you can actually enter a next position, or you can take profit, then enter at the same price and then take it. But the point is like when you're entering on a lower time frame, you want to enter at that price and then you want to go back up to the 1 hour and follow through. You can go to the 30-minute if you want a little bit more price action. But the thing is that if you stay on the 10-minute or the 5-minute or 1 minute, you're going to have like the smallest correction when this is live, and you're going to think it's going to come back all the way up to your entry. So it's really important you jump back to a higher time frame. Okay, so that's kind of the difference of the time frames. You're taking your entries on lower time frames. The lower you go, the more price action you see in the reactions at the number you want to enter on. And then the higher ones are for like targets and trend. So I hope this makes sense. Let me know if you guys have any questions in the comments. Make sure you like and subscribe.